Hi, Claudine. Can you please make me a presenter? Thank you. A very good afternoon, everyone. I hope everyone is well and doing good. Welcome to today's class again. We're just gonna be a bit longer today, and hopefully you can be able to keep up. So previously we have covered capital allowances, and today we are going to move to CGT, which is known as capital gains tax, where we're going to learn a few things out of CGT. So it becomes very important for me that you are able to raise questions today, because the topic that we are covering today has a bit of complications, not necessarily 100% complicated, but nevertheless, welcome. I hope everyone is doing well and ready for us to rumble. I'm going to go straight to the material that we have. We're going to go through the theory, and quickly from the theory, we're going to start doing the questions. I want us to follow some logic. First, just quickly go through the theory, and then we can do the questions. I am well aware that we might be having the lecturer present today. Please also note that this is our last class covering the last topic, which is CGT. I'm aware that there was a request from some students previously that we do one question paper. I do want to alert you that there is a podcast that is being prepared by the lecturers that they will release, where they will do tutorial letter 201, previous year's exam paper. They will try to explain each question up to its solution. So without any further waste of time, let me quickly go to the study guide. That we quickly cover the study guide, and then we can start the questions. So capital gains tax was introduced and applied from the 1st of October 2001. And definitely when it says that it was applied from the 1st of October 2001, it did not mean assets that are to be disposed. Sorry, I just quickly need to unmute that person. All right, I just have a hand that is raised. Tandy, is there something that you wish to say? Tandy, you've got your hand raised. Is there something that you wish to say? You are on mute. Okay. That Tandy is leaving. But for everyone, just to be sure, this is TAX2601. So let us proceed. So capital gains tax, as I said, it was introduced from the 1st of October 2001. It applies only to all disposals of capital assets. In to keep muting themselves. I will alert you as well when the lecturer joins us, so that I can give you an opportunity to put on any questions that you may have. So this CGT, capital gains tax, is an answer to a question that you've been having when we covered gross income. So remember, when we covered gross income, we say gross income is total amount in cash or otherwise that accrues or is received by in favor of a taxpayer in the year of assessment. And an important part is that the amount must be not capital in nature. So receipts that are not capital in nature would be excluded on the gross income. So what would happen now in this case is all those receipts that are actually excluded, all those receipts that are actually excluded on the gross income would now be included here, because now you have disposed of a capital asset that attracts capital gains tax. Therefore, this is the what we are covering today. It's all those receipts that are capital in nature. So this unit goes back to speak to the gross income, where we said assets are not subject to gross income, but then would be subject to the capital gains. And 7.2 just gives you an idea of references to the textbook that you may visit. But specifically, there are things that I've highlighted that I wish you can also highlight on your side, where you are specifically told that several transactions are regarded as deemed disposals for CGT purposes. This means that although a transaction is not an actual disposal, as described in section 6.5, where the asset is deemed to be disposed of at market value and immediately acquired at expenditure equal to that market value, the Act regards it as a disposal. For the purposes of this module, you need to be able to identify the following deemed disposal, where a capital asset becomes a trading stock, and there is an example about a car dealer, and where a trading stock becomes a capital asset. So those are the examples. The timing of disposal, for this module, the timing of disposal will be the date at which change of ownership takes place. So many things such as sale of agreement or things like that will not be considered. Please always look out for this graduation head comments. These comments are very important. When you are doing CGT, you must be able to determine whether the transaction in a question is a disposal or a deemed disposal. You must also be able to say whether a capital gain must be calculated for the current year of assessment, previous year, or the following year of assessment. So it is that part where we say in tax, unfortunately, you can't leave anything open. You have to provide an answer for everything. So every line item that you are given, you have to explain it. So when we covered capital allowances, I also illustrated for you that when you are looking at an amount that is an expenditure, you first look at whether the amount qualifies as a deduction in terms of section 11A, or it qualifies in terms of special inclusion, or if it doesn't qualify on both, you provide an answer to say, why is it not deductible, possibly capital in nature? And therefore, if it is capital in nature, then you must provide an allowance for capital allowances. So 7.3 gives you the basic framework, and this is the important thing, is that each asset is dealt with separately for the calculation of capital gains. So what is capital gains? Basic framework, it is proceeds, and that is selling price adjusted for capital gains purposes. So I will tell you just now how do we adjust it. Less base cost also adjusted, and this gives you a capital gain or loss. Remember, for the purpose of a calculating taxable income, here we need a taxable capital gain. We don't need capital gain or capital loss, but we need a taxable capital gain. So we will proceed up until you understand how do you get to a taxable capital gain. So after a gain or loss has been determined for each asset individually, you need to determine whether a total or partial exclusion can be applied. So we'll also cover the exclusion, but the important thing is this is the framework of calculating a taxable capital gain. It is proceeds less base cost, gives you a gain or loss, less specific exclusion. So what would be the exclusions? It would be assets. We'll cover now the exclusion just now. It is just on the last page of this learning unit. So here it gives you the whole framework of how everything comes into place. And this is basically what we are going to be applying today in order to be able to calculate tax capital gain, which is what we want to go and add to the line item called taxable income in calculating taxable income. And this taxable capital gain would be your aggregate of all assets that you have. So you are told here for natural persons, there is an annual exclusion of 40,000. You don't have an exclusion for a business entity. And then this is further broken down that you learn the proceeds on its own, and you learn the base cost on its own, and capital gains or loss on its own, and specific inclusion. So this is basically what we're going now to cover in terms of the capital gains tax framework. So for CGT purposes, proceeds are not always are not always equal to the actual selling price. These needs to be adjusted by recoupment. So this is a nice example provided of how you calculate recoupment and how you get to the adjusted proceeds. Important part is you need to memorize the process in order to calculate proceeds. The capital allowances will always be provided in an exam. You won't have to calculate them for CGT purposes only. So base cost. The important thing about base cost is to know that there is a base cost principles that are applicable to assets that are acquired after or on the 1st of October 2001, and there is principles that are applied to the assets that are disposed, but they were acquired before the 1st of October 2001. But what is important before we get to that is what is included in the base cost. So what would be included in the base cost? It is costs such as improvements to a property, agent's commission, valuation costs, and so on. But the important thing is these costs are capitalized into the cost of an asset. And excluded from those costs, one, are costs that are provided for in other sections such as deductions. So you are told that any other expenditure relating to this asset, repairs, maintenance, interest, which would have been deductible in terms of section 11A, is therefore not included. So when calculating base cost, it is also adjusted for CGT purposes. And here is an example of what costs are included in or excluded from the base cost. So here we've got flowers. That company, a private company, purchased an office building on 12 September 2006. So please note this is after the 1st of October 2001. So this date is very important for you to always know. And subsequently sold it on the 30th of November 2009 for 500,000. So this is the proceeds. So you are told that all costs incurred for this building are as follows. You've got a purchase price, transfer duty, valuation cost, legal and contract cost, interest paid on the loan to finance the building, repairs and maintenance of 48,000. You are told that the building was used in the production of income and the allowances were claimable for income tax purposes. No capital allowances were claimed owing to the fact that the office building was purchased before the 1st of April 2007 when the commercial building allowance was introduced. So required to calculate the base cost of the office building. So in this case, the purchase price will be part of the base cost, transfer duty, valuation cost, legal and construction cost relating to the asset. But what you're going to have excluded is your interest paid and your repairs. Because remember, these deductions were claimed already for income tax purposes when you did the part of deductions in terms of section 11A. So these ones would have been claimed already. So this is a summary for you to take note of what is included and what is excluded. So it is capital allowances and expenditure relating to the assets. So please note what is included is the purchase price as per the invoice, agreement, improvements, additions, selling and advertising costs, moving costs, valuation costs, transfer duty, and legal fees. So these are the important things that you need to know. So the first example that we are going to do is question 7.1. Question 7.1 covers assets that were bought after the 1st of October 2001. So this is the base cost formula. It's cost of an asset less allowable allowances that were claimed in the previous years. And this gives you the adjusted base cost. And here is an example. So this is what we are going to do. We are going to calculate taxable capital gain as required in this question, or a capital loss for the 2020 year of assessment. And in this case now, we're going to learn where do you start and how do you start. So this is what we are going to do for this question. We are going to test how to apply CGT principles when an asset was acquired after the 1st of October 2001. Sorry, just wanted to quickly look because I just want to see when we have the lecturer on board that I can be able to know. Yeah, I'm not sure if everyone can be able to see the screen. So we are doing, on your study guide, we are on page 55. We are going to do question 7.1 shortly. If you can just quickly read for me question 7.1 in your study guide. If you can just quickly read for me question 7.1. For those that just came in now, please remember to complete the attendance. All right, I believe everyone was able to quickly read question 7.1. So let us quickly go through the question together. Rings and Things Pty Ltd manufactures jewelry. So we can pick up that this is a private company. Its year of assessment ends on 31 March 2020. A manufacturing machine of the company was destroyed in a fire on 31st January 2020. The machine was originally purchased second-hand on 31 May 2018 for 500,000. So we can see this is after the 1st of October 2001. It was brought into use the same date in the process of manufacture. The capital allowances claimed in respect of the destroyed machine was 200,000. The destroyed machine was also sold to a scrap dealer on 15 February for 15,000. Rings and Things paid for advertising cost of 1,000 to advertise the scrap for the sale in several newspapers. An indemnity payment of 600,000 was received on 31 March 2020 from Rings and Things Insurance Company. Calculate the taxable income, sorry, the taxable capital gain or loss for the 2020 year of assessment. Right, so this is question 7.1. So we are requested to calculate the taxable gain or loss for the 2020 assessment. So what we know now is, in terms of the framework, what we basically need in terms of the framework is we need adjusted proceeds and we need adjusted base cost in order to be able to get to capital gains or loss. This is basically what we need in this question to be able to complete this answer and answer this question. We need to know what is the adjusted proceeds, what is the adjusted base cost in order to get to capital gains or loss. So for us to calculate adjusted proceeds, we're going to have calculation 1, and then we're going to have for base cost, we're going to have calculation 2. So this is basically your calculations here of how everything comes together. So for calculation 1, we know that we want to know the adjusted proceeds. So what is the formula to calculate adjusted proceeds? We know that it is proceeds less recoupment. So we've already addressed recoupment in terms of gross income. We addressed recoupment again in terms of capital allowances again. So this time around now we must read in order to get to adjusted proceeds. So in this particular case, we are told that the machine was sold to a scrap dealer for 15,000, and we are told in addition to that, we also received an indemnity payment of 600,000. Now, in terms of proceeds from the disposal of an asset is equal to the money received by a taxpayer in respect of the disposal. So in this particular case, the disposal is deemed to be a disposal because of the destruction of an asset. So in this case, we did not voluntarily sell this asset, but it was a deemed disposal because of the destruction, because of the damage caused by the fire. So in this particular case, our proceeds, 1, we've got 15,000, which is clear, where we sold to a scrap dealer, but we also have 600,000, which was received as an indemnity. This is proceeds because we have received money in respect of the disposal. So our disposal therefore becomes 615,000. 615,000. Any questions about that? Right, let us move on. So the formula says it's proceeds less recoupment in order to get to adjusted proceeds. So what is our recoupment? Now, in this particular case, it means that now we need to calculate the recoupment. Now, in order to calculate the recoupment in terms of its formula, recoupment is therefore proceeds less tax value. So it proceeds less tax value. This is when we are coming now to calculate recoupment, it's proceeds less tax value. So we must get the value. So our proceeds, we already know that it's 615,000, but we do not have tax value. This means that now we must also calculate tax value. That's why this is a bit of a long exercise, because you need to understand how everything comes together. So what is tax value? It is the cost of an asset less capital allowances claimed. So it is less taxable, sorry, capital allowances claimed, and then you get the tax value. This is your tax value. So let us now go back to the question and see if we can be able to get all these things. So remember, you want to calculate what adjusted proceeds, and this is calculation 1 for calculating adjusted proceeds. So what is adjusted proceeds? It is proceeds less recoupment, and now we do not have recoupment. We need to go to calculate recoupment, and recoupment, it is proceeds less tax value. Now we see that we do not have tax value. Now we have to come here now to calculate the tax value. So tax value is cost less capital allowances. So I'm just showing you here in brackets that it is capital allowances previously claimed. So let us look at this. So you are told that the machine was originally purchased second-hand on 31st for 200,000. So what is the cost? The cost is therefore 200,000. Sorry, the cost is 500,000. The capital allowances claimed in respect of the destroyed machine was 200,000. So remember, I've told you that this 200,000 will always be given. So which means that the tax value is therefore 300,000. Now you are able now to come and put this 300,000 here, and therefore you get to your recoupment. Recoupment of 315,000. But remember, the recoupment that you get here, it is compared to previously allowed capital, previously claimed capital allowances. Please don't forget this stage, very important. This recoupment that you get here is always, so it's recoupment of 315,000. It's therefore compared to what has been previously allowed. So what was previously allowed, we've been given it as 200,000. So this specifically means that your recoupment is therefore limited to claimed capital allowances and is therefore 200,000. This is extremely important that you always have this with you, which is therefore 200,000. So this is your actual recoupment. So it's limited to 200,000. So now we can go back to adjusted proceeds and say less 200,000, and therefore we get adjusted proceeds, which are 415,000. So we can have our 415,000 there. Therefore, we move on and we go now and do calculation 2. Calc 2 is a calculation of adjusted base cost. So what is adjusted base cost? The important thing now is you need to assess, one, in terms of your costs, what is included and what is to be excluded in terms of the information that you are given. And in this case, this means that we are going to say cost. So this is just for you to note. We are therefore going to say cost plus the inclusions. So in this particular case, we are given that the cost was 500,000 that we have been given. And we are told that for this machine to have been sold by a scrap dealer, the advertising cost amounted to 1,000 to advertise the scrap. And we know that advertising is part of the inclusions in the base cost. Therefore, this 1,000 is therefore added. And so this plus would therefore be advertising costs. And therefore, we're going to say less capital allowances. So capital allowances, you've been given them as 200,000. And therefore, we can be able now to calculate the adjusted base cost, which is 301,000. So in terms of the adjusted base cost, it's therefore less 301,000, which means that your capital gains or loss is 114,000. But now let us remember what the required says. The required says calculate taxable gain, because there is nothing called taxable capital loss. If you've got a capital loss, it is rolled over to the next year so that you can be able to deduct it to your future capital loss. Now, in this case, this means you must now get taxable capital gain. Now, in this case, we know that the inclusion rate, what you need to include into the inclusion rate is 80%. What does inclusion rate mean? It means only 80% is taxable. Hence, you'll include that 80% in your taxable income. Is there any questions up to so far? All right, so if there is no questions, so this means that the inclusion rate is 80%. So this means that only 80% is taxable. So in this case, it will be 114,000 multiplied by 80%, which gives you 91,200. And that becomes your taxable capital gain. And therefore, we have managed to answer this question on 7.1. Right. Let us move on. Now, in dealing with assets that are acquired before the 1st of October, assets that are disposed but were acquired before the 1st of October 2001, there is a framework in calculating the base cost, a formula that you have got to apply. It is, remember, everything will be the same for your proceeds. The only difference is going to be when you are doing calculation 2. They are saying the formula is different from this one. The cost that you are including would be the same. But in this case, on the 1st of October 2001, you will have what we call a valuation date value. And then you will include all allowable costs incurred on or after 1 October 2001. And then you will get your base cost. So what is the valuation date value? Again, it is the value of an asset on the 1st of October 2001. And this include all costs that increase the value of the asset up to the 30th of September 2001. Now, what is important in terms of the age schedule of the capital gains is that you understand how to apply paragraph 26 and paragraph 27 for the valuation date value. So you are given here the steps which you need to apply in terms of paragraph 26. The good thing is you will always be given this information in the exam, and it will be up to you how you apply it. So in terms of the valuation date value, you'll be given the market value. So you'll be given the 20% rule will be 20% multiplied by adjusted proceeds, less allowable costs, and then you will be given the time apportioned base cost as well. So you will not need to calculate them. So these paragraphs, you will always be given them as well. So in the case where proceeds, after they are adjusted, are greater than the total base cost, the valuation date value is the highest of A, market value, or 20% rule, or time apportioned base cost. If the pre-1 October 2001 portion of base cost cannot be determined, the valuation date value is the higher of market value or 20% rule. If the market value is adopted, as the valuation date in 26.1 and proceeds are smaller than or equal to the market value, the valuation date value is equal to the proceeds less allowable cost incurred on or after 1 October 2001. So we are going to do this question 7.2 to try now and apply this information that I've just given you. All I'm requesting you is quickly, if you need a leg stretch as well, you may take it. Have 3 minutes to read on question 7.2. At 22:05, we'll immediately start with the question. So quickly do for me. Read for me question 7.2. Those that have not completed the attendance, please take the opportunity to complete the attendance. Question 7.2. All right. Let us quickly now look at this 7.2. GoGo Pty Ltd. Again, very important to note. In CGT, you'll always have to calculate CGT for a company. Purchased an office building on the 1st of August 1984. This is actually what triggers whether the base cost of an asset is after the 1st of October 2001 or whether it is post that date. So this was the cost price, 1,235,000. No capital allowances were claimed in respect of this building. The transfer duty amounted to 133,500. During November 2006, improvements were effected. Please note, these improvements happened post 2001. Improvements were effected to the building, amounting to 832,000. The company sold the building on 15 December 2001 for 12,500,000. Assume the time apportioned base cost is 4,924,475,000. No, 475 rands. GoGo also paid agents commission to the amount of 67,500 when the building was sold. Calculate the taxable capital gain or capital loss. So this means if we are getting a capital loss, nothing will eventually go to the taxable income because you can only set off the capital loss against future capital gains. So so you must calculate taxable capital gain that GoGo realized in selling the building for the year of assessment ended 31st March 2020. If the market value of the building on 1 October 2001 was 12 million, and then B, if it is 14 million. Now, let us quickly now try and do this question. Question 7.2, we are asked to calculate taxable gain or capital loss. Right, the formula does not change, so I'm going to take this formula as is. It does not change. It's still the same formula. So this remains the same formula. This remains the same formula. That's the numbers that are going to change. So what is the easiest one that we can always do? We can always calculate the adjusted proceeds. So this is calculation 1. Calculations, calc 1. So we know that this is adjusted proceeds. So what is adjusted proceeds? We've already done this thing, so I'm just going to copy the formulas now. It's fine, it's proceeds less recoupment. So what is the proceeds in this case? We are told that the building was sold for 12,500,000. What is the recoupment for this building? Anyone who can share to us what is the recoupment? So you are told here, no capital allowances were claimed in respect of this building. So it means if there was no capital assets, capital allowances that was claimed, therefore you will not need to calculate recoupment. No capital allowances were claimed. therefore no recoupment. So this is what you know. That's why on your recoupment, we're going to have a nil. And therefore, this means that your adjusted proceeds is therefore equal to 12,500,000. So we do now the second question now in order, so the second calculation in order now to get the base cost. So we need to get the adjusted base cost. Now, this adjusted base cost, the important thing, it is for an asset that was acquired before the 1st of October 2001. So what does this mean? This means that now I need to have two columns where I can show assets that are before 1 October 2001 and also on or after 1 October 2001, and therefore I have my total. Sorry. We don't need to make these columns this big. We can just write the text. And then we've got the total. So this is basically what we need, because what do we need in order to calculate base cost? We need to calculate costs that are included, but for us to get what is the cost that are included, we therefore need to get it in this way, where we are looking at the cost. We are looking at the cost before the 1st of October 2001, after, on or after 1 October 2001, and therefore the total amount. So these are all rents, if you wish to make sure that one does not confuse these things. So the first thing that we will always know is the cost price will always be there. So the cost price is 1,235,000. So all that is important in tax is to be able to have what you call frameworks. So these things that I've given you today are frameworks to calculate CGT. You are then told that the transfer duty and transfer cost amounted to, so from here, you have got things that are included in the base cost, which in this case, for this purpose, we're saying that these are things that you are adding. So what are you adding here? It will be transfer duty. So it's transfer duty and transfer costs. And as far as we are concerned, this would have been incurred in 1984 as well, 133,500. And then we are told that there were improvements that were done in 2006, which amounted to 832. So it's improvements amounted to 832. And then we are told that the building was sold and there was agent's commission to the amount of 67,500. So we've got agent, please. So this was incurred when the house was sold. So we can be able now to cost these assets. So your total would be this column plus this column. So at this point, this means that the cost of your asset is therefore 2,268,000. But now we have to now follow the principles of paragraph 26. And I need you to go with me very slowly in this case, because I've already seen that someone has asked me. So 26.1 says, if the proceeds are greater than the total base cost, then the valuation. So it says paragraph 26.1 says if proceeds, how much our proceeds? It's 12,500,000 are greater than total base cost. And what is the base cost? 2,268,000. What does 26.2 say? Because we might not cover all these questions. 26.2 says if the cost of base cost cannot be determined, then the valuation date value, because remember, we are looking for valuation date value. Don't forget that we are looking for valuation date value. But paragraph 26.1 then says the valuation date value will therefore be the highest. So let us quickly look at what would be the highest. The valuation highest would be the highest, and they say A, market value. What is the market value that we have been given? B, 20% rule. C, time apportioned base cost. Now, I know time apportioned base cost has been given, and I've told you that it will always be given, and that is 4,920,000. Make sure that I'm getting it correct. 4,924,475. Market value. Here in the required, we were told that if the market value of the building is 12 million. 20% rule. 20% rule says, in order to be able to do the 20% rule, 20% rule says it is the adjusted proceeds less allowable cost as incurred on or after the 1st of October. So in this case, it will be, what is the adjusted proceeds? 12,500,000 less 899,500. So it's only less the costs that are incurred on or after the 1st of October 2001. So it says now the valuation debt value would be the highest of the market value, the 20% rule, or the time apportioned base cost. So which one is the highest? Anyone?
Is it the market value?
100%. So everyone can see that it is the market value. Now I want you to remember, what was the base cost formula in this case? It is, in order to get the base cost, it is the valuation date value, and then plus allowable costs, which are on or after 1 October 2001. So this is the formula to calculate the base cost. Not the adjusted base cost, but the base cost. Why am I confusing myself? So this would be your your main question to calculate the base cost. So this would be how you calculate the base cost. So this is the total of the base cost. So in this case, we have the valuation date value as the highest, which is 12 million. We've got the allowable cost, which is 899,500. Yeah. 899,500. So that is what your base cost is. So now we can go back here and say our base cost is therefore 12,899,000, which gives you that amount. And guess what you are getting? What you are getting is therefore a capital loss. It's not a gain. In this case, it will therefore be a capital loss. From this, you don't do anything. You cannot take this into the calculation of taxable income. You cannot calculate the inclusion rate of 80%. You can only set off this capital loss against future capital gain. Right. On the same breath now, let us look at B. So remember here, it says if market value is 14. So what was the, if market value is 12 million. So this was the case here where we had to do this if the market value is 12 million. So I don't want us to move far from here because the 14 million is going to request us to do almost similar calculations that we have done. So in this particular case, if the market value is 12 million or 14 million, so we are going to use the exact same workings. So in this particular case, this is 72.8. Maybe let us do these things separately. So here we just have a base cost. So we're gonna have here question 7.2 part B. Other things will be repeating, so we don't have to take everything. So this is the formula that we need. So the other case, it's when the market value was 12 million. In this case, now we have to calculate if the market value is 14 million. To calculate the adjusted proceeds, nothing really changes. You're just gonna have a similar thing. So nothing changes in that case. Right, let us quickly look. Then you have got to do question 2, which is to calculate the base cost. So nothing changes as well. You are going to take this information as is here. And the only difference now is applying paragraph 26. So remember, we have to apply 26.1 first. So 26.1 is the same as the other one. If proceeds are greater than the, let's take this. If proceeds are greater than the total base cost, then the valuation date would be the highest. Take this as is. Would be the highest of the market value. The market value in this case would be 14 million, the 20% rule. and the time apportioned base cost. Now, 26.3. So paragraph 26.3 says if the market value adopted in 26.1, so what is the market value adopted in 26.1? It is 14 million. If the market value adopted in 26.1 and proceeds adjusted are smaller than or equal to the market value, the date valuation date value is equal to proceeds less allowable cost. So 26.3 says if market value is I just want to read it correctly. 26.3 says if adjusted proceeds are smaller or equal to market value, then the valuation date value is proceeds less allowable cost. So allowable cost is anything that is allowable after the 1st of October 2001. So what does this mean in this case in simple words? It means if 14 million is smaller than the market value, if proceeds of 12,500,000 are smaller or equal to 14 million, then the valuation date value will be equal to proceeds. So what is our proceeds? Our proceeds, remember, it's 12,500,000. It's gonna be minus allowable cost of 899,500, which gives you 11,600,000. So this becomes the valuation date value. Is there any questions? Right? Then to calculate the base cost, because now we have the valuation date value, it becomes the valuation date value plus allowable costs which is cost incurred after the 1st of October 2001 and sorry, 23. Therefore, your base cost is therefore 12,500,000. So in this case, you would have base value, which is equal to, sorry, that thing, the formula there, it's capturing a wrong cell. So which means that your base cost will therefore be 12,500,000, and therefore you will not have a capital gain and you will not have a capital loss. Right. If you've got any questions, we're still proceeding. We will retest these principles now. That's why I've got a bit of a longer day today to iron out on capital gains compared to the time that we have put for the rest. So back again to the study guide. In 7.6, the important thing that we are learning is the capital gains that you are including in your taxable income. It's the aggregate. It's all the capital gains of your assets combined. So it's not one asset. So you go outside of your taxable income to calculate aggregate capital gain. And we've got question 7.3, which I'm not going to do. You can be able to do this on your own, just to test the principle that the taxable capital gain that you include in your taxable income is the total for all your assets. Then we have got exclusions per asset. The Act provides that in certain situations, the gain is made on the disposal or part of the gain that is made on specific assets and will not be taxable. These rules are referred to as exclusions. And for this module, the only exclusion that you have to know of is donations or bequests to government, provincial administration, public benefit organization, or recreational clubs. So in this particular case, it means these ones will be excluded and you don't need to calculate capital gains on these ones: donations and bequests to government, provincial administration, public benefit organization, and recreational club. And this is a summary of everything that has been done. CGT is proceeds adjusted by recoupment less base cost. Base cost is determined on whether the asset is after or on the 1st of October 2001 or before the 1st of October 2001, where you apply paragraph 26 rules in terms of the age schedule, and then your aggregate capital gains or losses. The capital loss from the previous year is deducted in order to get to net capital gain, and then you multiply by inclusion rate in order to get a taxable capital gain to be included in the taxable income. So the question that we are going to attempt again is question 7.4. And then after we are done with 7.4, we are going then to do 7.5. Is there any questions up to so far? I repeat again, we are quickly going to do 7.4. And then from 7.4, we are going to do the last question, which is 7.5. So I do know that today we were going to quickly have a guest, a lecturer was going to join us. So I quickly want to check if she's not in by any chance. All right, that's fine. I see that she is not in yet. I doubt that she will still join us for today. So we can still proceed. I wanted to give an opportunity for any questions. But please note, after we are done with 7.4 and 7.5, we are going to move on and in fact, I'm actually tempted that we actually do 7.5 only, because I think we have already done 7.4. Yeah, let us quickly do 7.5. And 7.6. So let's rather do 7.5 and 7.6. 7.6, why I love 7.6? It's because we are going to redo and refresh some of the capital allowances again. At 6 o'clock, just after 6, if we are not yet done, on the last 30 minutes, we are going to focus on the exam technique. So we're going to just go through question 201, and I'm just going to go through different questions considering the learning units that we have covered. So if you can quickly, again, for 3 minutes, go through question 7.5, and then we'll cover 7.5, and then after cover 7.6. So quickly have a read on 7.5 just for 2 minutes. For those that have not been able to complete the attendance, please remember to complete the attendance. All right, so let's move on. Gelati Pty entered into the following transactions for the year of assessment ending 31st March 2020. The required is to calculate taxable capital gain or loss of Gelati for the year of assessment ending 31st March 2020. Assume Gelati Pty Ltd has an assessed capital loss of 52,000 brought forward from the previous year. So we are going to deal with capital allowance, capital loss, assessed capital loss. It's assessed because this taxable income of the previous year has already been assessed by SARS. So we must quickly calculate taxable capital gain for transaction 1, transaction 2, and then see what is the net capital gain as well. So let us quickly start with transaction 1. But before we work on transaction 1 or transaction 2 as provided, so that you know where we are going to, please always remember this is the start. This is what we basically want to achieve. This is basically what we want to achieve. It is to calculate adjusted proceeds and adjusted base cost. But for this particular part, the problem now is we have to do this calculation for transaction 1 and do the same calculation for transaction 2. So let us start with transaction 1. Transaction 1. An office building in Cape Town was sold on 20 January 2020 for 3,500,000. The building had been acquired on 10 June 2001 for 3,200,000. Can anyone spot that date? What does that date say to you? This building, it was therefore acquired or bought before by
The 1st of October, 2001.
That's correct. Thank you very much. So this is the first thing. So that this is why it's important to be able to read the information. So the building had been acquired on 10 June 2001 for 3,200,000. The valuation costs were paid on 30 June 2002 to a SON appraiser who determined the market value of the building to be 3 million as at 1 October 2001. So this is the market value on 1 October 2001. Assume the time-based apportion cost was 3,218,545. The office building did not qualify for any tax allowances. So this is the best thing to hear, that there is no tax allowances. So it makes our calculations to go extremely smooth. So we're looking for the adjusted proceeds less base cost to get to capital gains or loss for transaction one. So what is transaction one? It's an office building. Right. Adjusted proceeds will therefore be simple because there is no, this is calculation. Calc 1. Adjusted proceeds because it will be proceeds less recoupment, and we know that in this particular case there is no allowances, therefore the recoupment will be a nil. And the proceeds, where we told how much it was sold for, 3,500,000. So this is our adjusted proceeds, is therefore equal to 3,500,000. And therefore our adjusted proceeds is 3,500,000. Base cost, in order to calculate base cost, this is calculation 2, is to calculate base cost. In order to calculate base cost, we need to calculate the cost, and the costs are before and after year end. So we're going to have these costs. So that's the reason I don't need to redo everything. I can just copy and paste. So we are told that the building was acquired, so cost price before 1 October 2001 as 3,200,000. Valuation date value was paid, so we've got valuation. We've got valuation costs, and this was on the 1st of. Can everyone pick it when it was? It was after the 1st of October 2001, which is 3,000. Any other costs that were incurred? Right, for transaction one, I'm not picking up any other cost. So this would mean that we've got 3,200,000 and we've got 3,000. Let's break down that. So that is the total cost. And from there, we can apply paragraph 26. So what we know about paragraph 26, the proceeds are greater than the total expenditure. In this case, if total are greater than the expenditure, then the valuation paid value. So I'm not going to write it in full. valuation date value is the highest of A, market value, 2, B, 20% rule, and C is the time apportioned base cost. So let us look if these we've been given. We are told that the market value was determined by the SON appraiser to be 3 million. 20% rule is therefore 20% multiplied by proceeds, which is going to give you 700,000. This proceeds, it's less costs that are allowable after year end. So it's therefore 699,400. Time apportioned base cost is 3,218,545. So what is the highest of these three? So one can be able to see that the highest in this case is your time apportioned base cost. So highest is time apportioned base cost of 3,218,545. Right, then we move on. It's easy now to do the calculation for the base cost, because now all we need to do now is to say valuation date value, which in this case would be 3,218,545 plus allowable cost. Allowable cost is cost incurred after or on the 1st of October 2001, which gives you 3,221,545. So we say, therefore, we're going to have our base cost as 3,221,545, and then we have a capital gain of 278,455. So please hold on to this. So we move on and we do transaction 2. What is transaction 2? Factory building. Let us quickly read about this one. Factory building constructed by Gelati was sold on 31 January 2020 for 7 million. Construction cost of the factory amounted to 5 million. And the factory was completed at the end of November 2018. The capital allowances claimed for this asset is 500,000. So here we've got a very easy line. So it's a similar thing that we have to go on, which is going to be long. Therefore, we have got to use this formula for assets purchased after the 1st of October 2001. Just going to delete these. So let us quickly go through calculations. Calculation 1, which is the adjusted proceeds. So we know that here we've got proceeds given 7 million. And we must now get recoupment in order to get the adjusted base cost. In order to get the recoupment, remember now we're starting the merry-go-round again. In order to get the recoupment now, we must say, in order to get the recoupment, it's going to be proceeds less tax value. So we already have proceeds as 7 million. We don't know how much our recoupment is going to be. We must now get tax value because we don't know what is tax value. So tax value is cost less capital allowances. So we are told that the construction cost of the factory building amounted to 5 million. The capital allowances, it's 500,000. Therefore, the tax value would be 4,500,000. Proceeds are therefore going to be less tax value, which gives you recoupment of 2,500,000. So is that recoupment, is there need to adjust for the recoupment of 2,500,000? Anyone? Remember, this recoupment is limited to capital allowances claimed previously. So what was claimed previously? So recoupment is therefore limited to 500,000. Of 500,000. Therefore, our recoupment, therefore, it's going to be 500,000. Adjusted proceeds 6.5 million. So there we have got 6.5 million. Now we need to go calculation number 2, which is adjusted base cost. So to calculate base cost, now we need to look at what is making up the base cost. So we don't see any other thing. So it just becomes then the cost price of 5 million less capital allowances and the capital allowances, it's 500,000. Therefore, your adjusted base cost is therefore 4,500,000. So this simply means, in other words, we've got a capital gain of 2 million for transaction 2. So we move on, and what we now do is we look now at the aggregate capital gain for the year, which is going to be now transaction 1, which fortunately we know that we've got capital gain, and then it's going to be transaction 2, which we also know that we also have got capital gain. Transaction 1, the capital gain was 275,455. For transaction 2, it's 2 million, which means that the aggregate capital gain is therefore, the aggregate capital gain is therefore 278,455. Now, in this question, you were told that in the previous year, there was an asset loss of 52,000. So it means that we have now to say less assessed capital loss. This capital loss, it's when you incur a capital loss. So it is only reducing future capital gains. So in this case, we are therefore going to have a net capital gain of 2,226,455. Now remember, in this question, what will be asked to do? It is to calculate the taxable capital gain. So to calculate the taxable capital gain, you have now to say this amount multiplied by 80%, which gives you 1,781,164. Any questions? Right. If there is no questions, let us quickly look at 7.6. 7.6, it's quite, this will reflect back now on capital allowances again. So I request that you just quickly have a read for about 5 minutes. We are starting again at 5:37. So we'll start again at 5:37. Please do not forget to complete the attendance. Right. Ndaenzo, if you can quickly unmute yourself whilst everyone is still reading 7.6. For the 20% rule, in this particular case, we say proceeds, so in bracket, it's adjusted proceeds, less allowable costs. So remember, allowable costs, it's costs that are incurred after 1 October 2001, multiplied by 20%. So this is what we do when we are dealing with the 20% rule. So I hope you are answered. All right, so we are back on 7.6. Please remember to complete the attendance. I'm just quickly going to share a link for those who may wish to leave before 6:30. And I'm hoping we won't have to get to 6:30, but we'll see how far we get. So let us look at 7.6. XLTD concluded the following transactions during the year of assessment ended 31 March 2020. Calculate the taxable capital gain or capital loss for the year of assessment ended 31 March 2020. So let us quickly look at this one. Question 7.6. I believe now this is more of questions that you would have to deal with in an exam. They would come in this way. So X concluded the following transactions. So number one, we've got a delivery vehicle. We are told that a delivery vehicle purchased on 1 July 2018. So this is the good part for 180,000, was sold on 30 November 2019 for 100,000. X Ltd claimed allowances of 63,750 on this asset and also qualified for Section 11O scrapping allowance where applicable. So in essence, now what we have to look at now is whether this asset we will be able to get the capital gain or loss on this asset. So we basically have to do the calculation. So we first going to deal with delivery vehicle. So I'm going to take I'm going to quickly copy the formulas so that I don't need to retype them all over again. So we're dealing with calculation one, adjusted proceeds. So we know that adjusted proceeds, it's proceeds. So we've been given here proceeds. It was sold for 100,000 and it's less recoupment, which we don't know what is going to be the recoupment, but we know that in order to calculate the recoupment, we must say proceeds of 100,000 less tax value. And now we need to calculate the tax value. Tax value, we know that it's the cost less capital allowances. right? The cost, we are told that the cost is 180,000. Capital allowances, we are told it is 63,750. So we've got a tax value that is 116,250, which means that tax value here, it's 116,250. So the amount that you get here is 16,250,000. This amount, because now it is negative, it becomes a scrapping allowance. So it's no longer recoupment. But when we were calculating this, we were hoping that we would be able to get recoupment. So in this particular case, it means this is therefore recoupment or scrapping allowance calculation in this particular question. So in this case, for recoupment, we've got a nil, which means that our adjusted proceeds now are therefore equal to 100,000. Are therefore equal to 100,000. Then the next calculation that we have to make now is calculation 2, to calculate adjusted base cost. To calculate adjusted base cost, we know that it is the cost or the cost price less capital allowances. Now we're going to learn a new one, less scrapping allowance. So remember the scrapping allowance, we have dealt with it in learning unit 6, which also forms part of the allowances that you can be able to claim. Cost price, it's 180. We know that the allowance is 63,750, and we know that the scrapping allowance is 16,250. Therefore, the base cost becomes 100,000. So adjusted base cost becomes minus 100,000, which gives you nil capital gains or losses. So that is about the first transaction, the delivery vehicle. So we look at the second one, which is looking at the office building. So office building. So I just forget to say this is number 2, and the first one was number 1. So remember, we don't have anything for delivery vehicle. Office building was sold on January 2020. The selling price was, the office building was purchased on 10 December 2006. So this is after the current year. So we can easily use this formula as well. So calculation 1, for adjusted proceeds, so that it is proceeds as recoupment. So how much is our proceeds? Is 2,250,000. The recoupment, we are told that cost incurred in connection with the office building for the period from 10 December 2006 to 20 January 2020 amounted to 1,076,000 and consisted of the following. So we are told what was the following. No capital allowances were claimed on this asset. So this means we do not have recoupment. Therefore, our adjusted proceeds is 2,250,000. Don't forget to always specify why we don't have recoupment. So why don't we have recoupment? What would be our simple reason? It's simple. No capital allowances claimed, therefore no recoupment. That's how simple it gets. So we've got adjusted proceeds. So now we need to do calc 2 for adjusted base cost. So we know that this is going to be cost price then plus the inclusions. So cost price, we know that this building was purchased for 1,600,000. So let us look at the other costs that have been incurred. So we've got improvements. So improvements, straightforward, they come in. Improvements, 220,000. We've got transfer duty. And transfer costs, they also come as 236,000. You've got interest paid on mortgage. And then you've got property tax. So they tell you that property tax and interest on mortgage were allowed as deductions for income tax purposes. So it's always important that this now must flow into your solution. So in your solution now, what you are going to have now is you are going to specify now the reasons why you are not including these ones. And therefore, this becomes your reasoning. So this becomes your reasoning that this is the main reasons this were not allowed. So we're going to have them here as 0, 0. And therefore, your cost price total becomes 2,056,000. So remember, that will basically be the calculation of your base cost, 2,056,000. You have already been told no capital allowances have been claimed, so we do not have to calculate the tax value. Then this becomes 2,056,000. And therefore, this means that your capital gain will therefore, sorry, must be a minus, will therefore be 194,000. So let us look at third transaction. Third transaction says XLTD's assessed capital loss brought forward from previous year of assessment amounted to 75,000. So what we need now to do, it is to do aggregate capital gain. So what are we going to do? We're going to say delivery vehicle. How much is the delivery vehicle? 0. And then we have transaction number 2, which is office building. Office building is therefore 194,000. And here we have got aggregate capital gain of 194,000. And then we say less the assessed loss brought forward, less capital, less assessed capital loss of how much? 75,000. and gives you net capital gain of 119,000. So let us look at what the question asked us. We needed to calculate the taxable capital gain. So the taxable capital gain would therefore be 119,000 multiplied by 80%, which gives you 95,200. Any questions? Any questions? All right.
Why must we multiply by 80%?
Remember, what does 80% say? 80% says what is taxable. So the 80% is the inclusion rate into the taxable income calculation. This is the inclusion rate for you to include something into the taxable income, for you to include the taxable capital gain. So what is taxable out of a capital gain is only 80%. So this line item goes to the part where you are doing the calculation for taxable income.
Okay.
Let me show you this part as well so that you can be able to get the flow. So this is your framework of calculating taxable income. So we have done the income less deduction. It gives you taxable income. Then you say add taxable capital gain. This capital gain that you include here on this calculation is only 80% of the capital gain, because what is taxable is only 80% of that.
Okay.
For you just before So what I'm going to just ask from you before we move on to the
Sorry, we missed. If you can just go back 1 minute, it wasn't clear now. There was a sound, something. If you can just go repeat what you just said before this. Sorry.
No, it's fine. I was just muting that person that had the noise.
I was also okay. Because with the rest of us couldn't hear.
All right.
Okay.
No, that's
also just going to check who it was. Sorry about.
All right. So what I wanted to say was, before now we focus on the exam technique in preparation for the exam, I just want to give you an opportunity to ask questions on what we covered today, plus any other learning units that we have done previously. And I also want you to take this opportunity because we've got Mrs. Wenzel Linata, who is also present. I've just spotted her now. So if you also have any questions that you might need to ask from the lecturer as well, she's also present with us today, so you can be able to ask her as well. But please, any questions, any area that you want me to repeat, I've got the last 30 minutes for you. Then it's gonna be you and the exam. So you've got 30 minutes. It's myself present, and it's also the lecturer. So you can post your questions. It will be a Q&A session. So you can ask a question, then I will ask Mrs. Wenzel to answer. But just before asking Mrs. Wenzel to be answering questions, if I can just give maybe let's start with the questions, and she can maybe bring also any important thing that she would need to highlight for you when she's done covering the questions. So any questions?
If there's no questions now, but feel free to interrupt me, any of you. Hi, Zukisani. Hi, all the students. Mrs. Wenzel, yeah. Thank you again for your class for the students. It seems like the students are really benefiting from going through the study material that they already have with somebody just explaining it to them. Going through it as you would approach a question in the exam. So thank you for that. I think it's good for the students also to listen to the recording again and to think about the mindset that they must have approaching a capital gains tax question. The thing is, with all the other learning units, you've been assessed already with assignment 1 and assignment 2, but with capital gains tax, because it's the last learning unit, there's no time for us to assess you or to let you practice. So the questions in the study guide is your practice, and that's why it's useful to go through these questions over and over and over again, and doing it yourself without looking at the answers and then going back to see where you went wrong. So that you are prepared for the exam in terms of how to do the question. What I can still say just on capital gains tax is, in the exam, we will ask you the sub questions of getting to the end. So for instance, in the questions, it says calculate the taxable capital gain. In the exam, we will say, for asset A, calculate the proceeds, or calculate the recoupment, calculate the adjusted proceeds. Then for asset A, calculate the base cost, and then calculate the capital gain. Then for asset B, calculate the tax value, calculate the recoupment, calculate the adjusted proceeds. So we will guide you for the second year level. When you get to third year level tax, you will get this one-liner that you see in your study material, calculate the taxable capital gain of the company. So that's just a heads up in terms of, we will guide you in terms of what calculation must you put down for part A and B and C and D of the capital gains tax question. I hope that will help a bit, but you must still know your formulas so that you can jot it down. I don't see a question in the chat or a hand up. I can maybe just conclude from my side now. In terms of preparation for the exam, it's necessary for you to be prepared to write out the questions or to type the questions. Like, it's going to be an online exam. You're going to download the exam paper, write out on a piece of paper and scan it in and submit it, or type it on your computer or tablet or any device, and then save it and upload it on MyUnisa. So what I'm saying is being prepared to write it out, to type it out. Exercise yourself beforehand to do this type of questions so that it's not new for you to go and write together with the online experience. So the most that you can do beforehand to get used to this, the better. I will post a lot of communications in the next 2 weeks regarding the online exam. I'm guessing that most of you have already experienced the online exam in the May-June exam. And if you have, it will be similar. It will be the same type of downloading, uploading experience. For those of you who haven't done it yet, please follow my instructions. like I say, I will have a lot of communication to prepare you what to expect, what you must do, what you mustn't do, what you can do beforehand to be prepared in terms of number your pages, put in your student number beforehand, that type of thing. So please read and please do what I suggest. It will help you a lot. We've seen that those students that actually do the things that we suggest really find it much more peaceful and not so stressful. Yes, and like I said, be prepared in terms of content and be prepared in terms of exercising. Sorry, there's one thing I wanted to say now. Don't count on it to use your study material or your textbook or your notes when you write the exam. It's obvious that it can be, that it will be open book because there's nobody looking over your shoulder, you're writing on your own. But you won't have time to go and look for the answers. You won't have time to see what rate must I use now for this machine. Oh, now I must go and look, is it new or is it used? What rate is it again? Be prepared beforehand. You must know your stuff. Otherwise, you're going to waste time and you're not going to finish your paper. There's no time to go and look in your book. And also it will make you'll probably get confused when you now have to go back and forth and writing out. So yeah, again, being prepared beforehand. Don't wait until the weekend before you write to study for this module. I'm supposing for you guys that are actually listening to this recording or this session, you are preparing beforehand. So well done for that. Just keep pushing. You have 3 weeks left and to get through all the stuff and the exercising of the questions. And that I would suggest, I would think you are prepared if you've done that. Yeah, are there any other questions? Any hands up? Any comments? You're welcome.
Thank you, lecturer. My question is how it's about the questioning on theory. Must we expect that also on the exams except the calculations?
Okay. Yes, there's always a theory question. The theory will basically be relating to the gross income or the general deduction formula. So it's the study unit 4 or 5, where we have a theory type of question where you have to list the requirements of either the gross income or the general deduction, and then apply the facts of the case study to each requirement and giving a final conclusion. Let's say, for instance, it's a general deduction formula, and we say that this company had this expense on these dates and blah, blah, blah. Then you say the general deduction formula says it's the actual amount actually incurred during the year of assessment. So you list them each and then apply the criteria to it to say that it is on this date. So in other words, it's during the year of assessment or it's not during the year of assessment, applying each requirement, and then at the end says this deduction will not be deductible because it is capital in nature as described above, so it will not be deductible. So putting it in a formula of requirement, application, and then a final conclusion. The easiest way basically is in a table format, where on the left-hand side you have your requirements, on the right-hand side you apply it, and then you have a conclusion. Can I just quickly say, applying the facts is not really regurgitating is the word that I'm saying now. It's not merely repeating the facts. Let's say, for instance, during the year of assessment, and you say incurred on 30 September 2020. Now that doesn't tell me anything. You must say incurred on 30 September 2020, therefore after the year of assessment that ends on March 2020, for instance. So don't just repeat the facts, really actually apply them. Is there any other questions?
Thank you.
Leisure.
Yes, lecturer, my question is the previous semester's question paper is not uploaded. Is it possible that we're gonna get it or we won't get it?
The previous year's exam papers are uploaded by ICT and the exam division. We as lecturers don't do it. So that's why it's not uploaded. It's usually only the next year, the previous year's papers are uploaded. I don't have a problem providing it for you. I'm thinking now on my feet that I'm debating, but I think we will have a type of a mock exam. I will definitely communicate that this during the week because I'm still thinking about how to do it. But if we have a mock exam, maybe I should then provide the paper for the mock exam. But you will have access to it for the whole time. So let's say, for instance, we have a mock exam in a week's time, then you will have access to it until the exam. So it's not like it will only be available for those few hours of the mock exam. So in any way, I will make it available either by an announcement and attaching it as additional resource or in the announcement, or I will just use it as the mock exam. Is that acceptable to you, so that you will have it, but I'm just deciding still where to use it and when to give it to you, but it will be way before the exam to work through. Is that okay with you?
Yes, ma'am. Thank you.
Because if you look at previous year's exams, every exam is new. We really set up these questions from the start. But there is a structure. You will see that there are taxable income calculations, there are CGT questions, there's mostly the provisional tax question, that type of thing. So there's sort of a structure, although it differs from year to year or from exam to exam. And so it won't really help you to, I won't say memorize, but to exercise the paper and think that you will be able to do the next one just by doing the paper, because every year's paper is different. So that's why I'm saying you must know your content to answer the paper, but this will then be an additional exercise for you to do. And I would suggest that I will definitely do it when I provide it to you. I will also say it then, to try it by yourself, under time constraints, under pressure, writing it out or typing it out, and then see how you perform as an exercise. And then afterwards, use it as an exercise by doing it again. I'm realizing now the solutions. We will decide on the solutions, but I'm thinking how to approach it. I'll think about that. But the exam paper you will definitely get, although the solutions, I'm just still thinking how to approach that the best way to for the students' benefit, so that you don't only use it as a oh yes method paper training. But I will definitely think about that.
Hi, ma'am.
Yes.
Please think about it, because I think it will help us to, when it's come to, especially to me, if I can talk for myself, in order to know how we expected to answer the questions. For example, for the theory parts, when it's come to requirements, applying and conclusion, not that we will take it exactly, but we'll have an idea how to answer. Is that possible? Please.
Yes, I hear you. The structure of a theory question, the most of previous exam questions are in the end of the study guide. We often update them to take more recent question papers and include the answer as well. So what you have in your study guide is actually previous exam papers with the solution, but just for that subject. And then I'm thinking, for you guys that's now writing in October, the May paper is still valid. It's still current legislation. So there's no harm in giving you the paper, as we don't give previous year's papers because of legislation changes and the figures won't be the same. But what about the guys that wrote in May? They didn't have that. So you have a very huge benefit of getting a previous exam paper with a full solution. But yeah, that's then probably you can argue, well, that's just how it is. You're writing the second semester, so you can get the first semester. So the guys that writes in May next year won't have the previous year exam paper with a solution because it will be outdated by then. But yeah, we can argue about that. I will most probably give you the solution. I hear your argument in that. But I'm not guaranteeing it now. I'm not saying yes now, but it will most probably be provided. I hear you. Anyone else?
It looks like everyone is covered.
If there's any other questions, you are really welcome to email us in the TAX2601 mailbox. You'll find the email address in your tutorial letter 101, and it's also on the welcome page of TAX2601 on my UNISA. So we monitor that daily. So if you have any other content questions, then you're really welcome to contact us there, and we will get back to you if you think about something else now afterwards, after this session.
Definitely, thanks a lot, Renata, for also
Okay, students, so Sukisani, I couldn't hear you now, but just again, Renata, thank you very much. And then students, just a reminder now, like your lecturer said, please watch the announcements on the page for the next 2 weeks. Follow the instructions in the announcements. Go and look at the additional resources that have been provided to you, and all the best for this exam. Thank you.
Thank you very much, Claudine. I'm hoping that I must be fine now. Just want to go through the last things. It's also preparation towards the exams. So I'm just going to quickly share my screen. Very important things that I wish to just go through with the students, especially the announcements that were covered previously. Please do not forget when you are going through your textbook to go through this correction that was provided on the announcement. These announcements are very important because they help you to understand errors that are in the textbook so that you can understand it fully, especially when you are covering section 11.0. People normally ask a lot because the solutions that are provided by the on the tutorials, they normally give you the section number and all that. So just very important for you to note, what is very important is you need to provide the reason when the amount is not taxable or not deductible. So say an amount is not to be included in gross income because it's capital in nature. That's what you need to provide, not necessarily any particular reference to the Income Tax Act. There is an example of bonus provision provided. And again, just to reiterate so that you can have this in your planning, today is the 6th of October. You are writing in 20 days. On the 26th of October, please make a proper plan for this particular date. that you know what is your plan going forward. As Lenata has said, the exam information will be provided, but this is things that you need to prepare for at this point, is to have a device that you will be scanning your paper on and you'll be sending through your paper. And the second important thing is you will need data to be able to write successfully on your exam. So please, if you have to do your budget, if you have to ask someone to fund your data, please make sure that you put those plans in place now. Another important thing, because you'll be writing at home or in your own private secluded area, please ensure that you have planned for where you'll be writing, because these will be online exam. And make sure, very important, make sure that you will have enough privacy. You will not have disturbances in the particular place that you'll be writing on. So, of course, you've got tutorial letter 201, which gives you the topics that were tested in the previous exam papers, so you can have a feel of all the work now integrated. So remember what we have done in the past weeks that we've been working, past 7 weeks. We have done Learning Unit 1 on its own. We have done Learning Unit 2 on its own. We have done Learning Unit 3. So we've covered the introduction. We've covered the administration, the forms that you need. We have covered different types of taxpayers, which also included provisional tax calculation, micro businesses, small business corporation, other kind of companies. We moved on, we covered gross income, deductions, capital allowances, and today we did capital gains. So in 7 weeks, we have covered 7 learning units. Now, when you come into an exam, all these 7 units will be tested in a integration manner. So you won't be asked Learning Unit 1 on its own or like that. So this is an example of tutorial letter 201, which you have under additional resources. So it provides you 4 areas that were tested in that particular question paper. So this is just for you to have a feel. So what is important, and as a student, to make sure that you don't cheat yourself. This is the only way that you can learn and prepare for exam, is to do this practice of this paper under exam conditions. So what is exam condition? It means you close every resource, notes, textbook recordings. You close everything up. It's you and this question paper. You can even attempt to do this question paper online. What does that mean? It means have this question paper in front of your iPad, your laptop, your phone, and read it online exactly as you would do when you are preparing for the online examination. To do this paper, you need 120 minutes. So please time yourself for each question. So what does this mean? This means if you are using a black pen to do question 1, which asks you to calculate tax liability of a company, and then 36 minutes is finished and the question is not yet done, please change the black pen and use the blue pen to continue to complete the paper. And then you move on to the second question. You try to complete in 26 minutes. If you can't, you change the color of a pen. Now, when you are marking yourself, because the solution is also available after this paper, after this question, when you are done and you are marking yourself on the solution, mark yourself how many marks you would have received for completing each question in time, and how many marks you would have received had you completed the whole question in time. So both the colors, blue and black, you mark them. So what is important now is you establish whether you have got a problem of a speed in writing, or whether you've got a problem of not understanding the principles. So you will find in these questions, most important things that are highlighted for you to know are highlighted or underlined. For example, for every question that you need to read and you are provided for exam, you need to know what kind of a taxpayer am I dealing with? Is it a small business corporation? Is it a micro business? Or is it an ordinary company? So that's the important thing. Because if you are calculating a tax liability, you need to know what tax rate is applicable for that particular taxpayer. So in this case, it's a private company. You are told that it is not a small business corporation as defined. Important thing, donation section 18A, you know that it is the last calculation before you get to your taxable income. So if you get expenses clustered in this manner and you are told that this is just salaries and wages, and additional information gives you how they are broken down, for you to get marks, you need to make sure that you write them in and uncluster them or break them down. One of other important thing is, as you are given this line item, if it is not taxable, you must still provide a comment why it is not taxable. So please don't forget such things. So a capital asset may, if you purchase it in the current year, it may not be deductible under section 11A, but you may provide a capital allowance for it. So those comments, as we have gone through the questions previously, needs to come up. So please try to use these resources that you have. This is an example of part B that says list the requirements set out in the income tax in order to qualify for a small business corporation for income tax purposes. So we have covered these things where we say the gross income must be less than 20 million. We've said that the shareholders must not be natural persons. They must not have other interest, and you've got most things that are covered in terms of a small business corporation. You can also refer to the notes that I've uploaded when we covered each taxpayer. So in this case, you are told Minora CC is a small business corporation. This means that the tax rate that is applicable is for a small business corporation. Question 3, you have to calculate a tax capital gain. So you have to do exactly what we did today. The first important thing is to determine which year was the asset acquired. So if the asset was acquired after 1 October 2001, then it becomes easy. If it was acquired before then you are going to need to apply paragraph 26. So here you are told calculate only the base cost. And then this one is about provisional tax. We have done it before. And this one is discussed with reference to case law. So this is why it's important that you ensure that when you are reading, your textbook, your study guide becomes your main material that you need to look at, and all other additional resources such as question papers, what the tutor has done becomes your additional material. So this information will be provided in exam. Tax rate will be provided in an exam other than the normal tax rate. So tax rate applicable to micro businesses and small business corporation will be provided. Binding general rule information will be provided as well. Intellectual property in terms of the patents, copyrights, and all that, the monetary values that you can apply for capital allowances, prepaid expenses, small business corporation as well, there it's provided, and here is your solutions. So that is basically giving you almost what is going to be covered in terms of the exam. So with that, please allow me to wish you all the best for the exams. please make sure that your theory is 100%. Please make sure that you are able to understand principles in order to do the calculations. So my time is up, and I really wish you all the best for the 26th of October. Please, if you've got any questions, please use all available resources. Mrs. Wenzel and the lecturing team, they are very much helpful in responding to queries. Please make sure that you are not stuck alone. They are there to support you for the exam. And thank you very much. Enjoy the rest of your evening. And please make us proud. We need more graduates, not only graduates, but people who learn the material and understand it and are able to apply it in future. So all the best, and thank you everyone for the remarks that you are putting in. Please do not forget, I will be to put your remarks as well on the evaluation form, but thank you very much. Mrs. Wenzel, as we are closing, I'm not sure if there's anything that is triggered that you just want to leave for the students. If there's nothing, you can just wish them the best as well for the exam.
Thank you, Zukisani. Yes, I've mentioned in the chat that you've given excellent advice now in terms of the two colors of pens and the overall approach. Very well done. There's nothing more for me to say, actually. I'm wishing you all the luck for the exam. Like I say, if you are prepared, then everything will go right for you on that day. Just relax, don't stress too much, because that might bugger up your brain and your concentration. So be relaxed. Do it as a challenge and to show to yourself that you can do it. So good luck. I really want you to be successful. And thank you for your partnership in this as well, Zukisani, and the whole, what do you call it, Western Cape area, this whole forum. I really appreciate it a lot. I think our students are very glad, are very fortunate to have you there. So students, good luck. I'm rooting for you. Have a good evening further. Thank you. Bye-bye.
Enjoy your evening. Thank you very much, and goodbye. All the best. Thank you.
Thank you. Bye.